If you think gold failed because it fell during a war, you are looking at the wrong market. That is the first thing I need to get into your head. Not next week, not after the next headline. Now, because if you misread what just happened, the next move you make could hurt you far more than the last drop already did. Most people still carry around a cartoon version of Gold War starts. Fear rises, gold goes up. That is the handbook version. It is tidy. It is emotionally satisfying. It is also incomplete because gold is not one market. Gold is two markets wearing the same name. One is paper, one is physical, one is fast, levered, emotional, and ruled by flows, algorithms, and forced liquidations. The other is slower, heavier, harder to shake loose, and owned by people who do not confuse the screen price with the thing itself. If you do not understand that split, you will keep asking the wrong question. You will ask, why is gold crashing during a war? Wrong. The better question is, which gold market is crashing, who is being forced to sell it, and who is taking the other side? That is the real question. That is where the money is. That is where the truth is. And once you see it, the move stops looking irrational. It starts looking like one of the oldest games in finance. Leverage gets margin called machines, accelerate the move. Weak hands puke up claims on the asset. Strong hands use the panic to take more of the real thing. That is the mother line for everything I am about to say. What crashed was not the idea of gold first. What crashed was the paper structure built around gold. That distinction is the whole story. If you miss it, you will do what ordinary investors always do. You will see the red candle, assume the thesis broke, and hand your position to somebody with more patience and less emotional need for neat explanations. I have watched this play out in market after market. Different decade, different asset, same confession. In good times, leverage flatters. In bad times, leverage confesses. And paper gold, especially when it has been stuffed full of borrowed conviction, confesses very loudly. Now let me tell you the basic mistake people are making. They think a falling gold price means gold itself is being rejected. Sometimes a falling gold price means the derivative machinery attached to gold is being liquidated while the underlying metal is quietly migrating from nervous owners to determined ones. That is a very different event. If you own gold, if your retirement account touches precious metals, if you think of gold as insurance, or even if you just think of it as a speculation, you need to understand that difference immediately, because the next step you take depends on what kind of market you think you are in. If you think the whole thesis broke, you will flee. If you think you are watching paper liquidation against stubborn physical demand, you will behave very differently. One interpretation leads to panic. The other leads to process. That is what I want for you. Not certainty. Process. Now let me begin with the first mechanism. I call it the safe haven override. The safe haven override is what happens when the normal instinct to buy gold during geopolitical fear gets temporarily crushed by a stronger chain reaction. Definition is simple. War does not only create fear, war can also create inflation pressure, dollar demand, higher bond yields, and forced selling conditions that hit gold harder in the short run than the safe haven bid can support it. That is exactly what confuses people. They think one force should dominate, fear equals gold up. That is not how real systems work. Real systems are layers. War can push oil up. Higher oil can make inflation look hotter. Hotter inflation can reduce hopes for rate cuts. Reduced hopes for rate cuts can push bond yields higher. Higher yields and a stronger dollar can trigger automated selling in paper gold structures. Now gold is falling during the same war that people thought should make it rise. That is the safe haven override. It does not mean the safe haven function vanished. It means another mechanism hit the tape harder and faster. That distinction matters because if you do not understand it, you start telling yourself silly stories. You say gold is broken. You say the market is rigged. You say nothing makes sense, something makes sense. You just have to follow the dominoes instead of the emotion. If oil spikes because a major transit route is disrupted, that is not just a commodity headline. It is an inflation accelerant. It gets into transport, food, plastics, chemicals, logistics, expectations, politics, and interest rate assumptions. The market then starts repricing central bank behavior. If the market thinks the Fed cannot ease as fast as hoped, or may even have to stay tighter for longer, then the entire environment for leveraged long-duration trades changes. Gold, especially in the paper market, gets caught in that repricing. Again, not because gold as an idea stopped mattering, because money is reacting to the intermediate variables. That is why people who only think in slogans get massacred. They heard the slogan, "War bullish for gold." They did not study the mechanism. Mechanism beats slogan every time. Now let us move to the second mechanism. I call it the yield shock. The yield shock is where the gold story stops being about metal and starts being about money, competing with money. Most investors still pretend they are comparing gold to nothing. That is not the real comparison. They are comparing gold to available yield in the safest looking government paper they can buy. If 10-year yields are high and the dollar is strong, then a lot of capital that might otherwise be sympathetic to gold starts saying something brutally simple. Why sit in a metal that yields nothing when the paper is paying me well and the currency is appreciating? That is the yield shock, and that shock does not ask whether bombs are falling. It asks what the present reward is for holding the alternative. That is why gold can get hit during exactly the kind of event people thought would make it moon. The safe haven story is colliding with the yield story. If the yield story wins for a while, paper gold gets sold. Again, you are not watching the death of logic. You are watching competing logics with different speeds. This is why I care so much about the dollar index and the 10-year treasury. Yield in an environment like this. If the dollar is too strong, gold has a headwind. If the 10-year is too attractive, gold has a headwind. It does not mean gold is finished. It means the metal is fighting a stronger short-term crosswind than most people want to admit. A lot of investors need every move to confirm their worldview. Markets do not owe you that. They owe you nothing. They simply reveal which force is strongest right now. That is the yield shock. Now let us move to the third mechanism. I call it the machine cascade. This is where the move stops looking human. The machine cascade is what happens when algorithmic systems, trend rules, and systematic money all start selling the same thing because the inputs turned against it. This is one of the most underappreciated features of modern markets. People still imagine a market as a room full of thoughtful men making case. By case decisions, that world exists in pieces. It is not the whole system. A huge portion of modern price discovery is rules, models, thresholds, flows. If a certain support breaks, if yields move a certain way, if the dollar crosses a threshold, if volatility expands, if momentum flips, the machines do not sit there pondering whether bombs are falling in the Middle East and whether gold should be acting nobly. They sell. That is their job. And when enough of them do it at once, price starts moving in a way that looks bizarre to the human being who is still interpreting the market like it is a moral story. It is not a moral story, it is a flow story. This matters because paper gold lives inside that flow story. Futures contracts, options, leveraged exchange, traded structures, systematic funds. When the inputs flip, those structures can dump exposure very fast. That is the machine cascade. The first wave is logic coded into rules. The second wave is humans seeing the price break and selling because they think the break itself means something mystical. The third wave is leverage getting called. By then the move looks enormous and everybody online becomes an expert in hindsight. That is always how it works. The market is not asking for your opinion in those moments. It is taking inventory of who is overextended. That is why I do not waste time being morally outraged that machines can run part of the market. They do. Complaining about that is like complaining about gravity. I would rather understand the rules they are following than cry about fairness after the damage is done. Now let us move to mechanism 4. I call it the leverage death spiral. This is the part that destroys retail investors. A lot of people say they like gold. What they really like is gold with gasoline poured on it. They do not buy unleveraged exposure. They buy products that promise 2 times or 3 times the daily move because they want to feel brilliant faster. This is one of the most reliable ways to turn a correct big picture idea into a painful outcome. Leveraged products are not just more intense versions of the same investment. They are different machines. Daily reset matters. Rebalancing matters. A falling market forces behavior inside the product that ordinary holders do not understand until it is far too late. If the price drops, leveraged holders get hit harder, they get margin, called faster, they redeem, the product has to rebalance, that creates more selling into weakness, that causes more price pressure, that triggers more fear, then more selling. That is the leverage death spiral, and once it begins, it stops being about your original thesis. It becomes about the mechanics of the product. This is why I have such contempt for people who treat leverage as a harmless accelerator. Leverage is not just speed, it is fragility. If your long-term idea requires a structure that can get knocked off its feet in a violent week, then your long-term idea is living in the wrong vehicle. That is not a small mistake. It is a category error. A lot of investors think they are owning gold. In truth, they are renting amplified exposure to daily price changes in gold. Those are not the same thing. One can be patient, the other can get its face ripped off by a few sessions of bad tape and forced rebalancing. This is one reason I always tell people that if you want a long-term strategic view on a monetary asset, the dumbest possible way to express it is often the smartest physical, if appropriate, unleveraged exposure, if not time horizon, cash flow, patience. Those are adult words 2 times and 3. Times products are often teenager words used by grown men with apps and no structure. That may sound harsh. It is still true. Now let us move to mechanism 5. I call it the paper. Physical split. This is the core distinction. This is the one most people do not understand. The paper, physical split, is what happens when the quoted market price of gold is being smashed in derivative markets, while physical metal is simultaneously being pulled out of the system by buyers who are using the discount. That sounds contradictory only if you think paper claims and physical bars are interchangeable in every meaningful way. They are not. Paper gold can be liquidated aggressively. It can be sold in size, it can be leveraged, it can be created, hedged, unwound, rolled, or dumped by participants who never wanted to take delivery of a bar in their entire life. Physical gold is heavier, slower, harder, it sits in vaults, it changes hands differently, it gets bought by people and institutions who think about storage, sovereignty, reserve diversification, wealth preservation, sanctions, risk, family capital, and long time horizons. Those are different animals. So when the paper market crashes and physical gets taken away quietly by strong buyers, you are not watching a simple price story. You are watching a transfer event. That is the point. The weak ownership is being flushed. The strong ownership is accumulating more real metal. And if you do not know that is happening, you interpret the entire move incorrectly. This is why I always respect physical signals more when paper and physical diverge. Physical demand is harder to fake. A panic futures market can be spectacularly wrong in the short run because it is dominated by leverage, rules, and temporary needs. A buyer taking actual bars off the table is making a different statement. He is not saying, I think we bounce tomorrow. He is saying, I want ownership of the real thing at this price. That is a much more consequential act. Now let us move to mechanism 6. I call it the 1983 echo. History never repeats cleanly, but it rhymes more often than the crowd wants to admit. The 1983 echo is the pattern where Middle Eastern stress and reserve pressure combine to produce gold selling for reasons that are not about faith in gold and not about retail enthusiasm. The details change. The structural lesson does not. When oil producers or energy-linked states face severe pressure on revenue, reserves, or currency management, gold can become the asset they monetize to keep the broader system stable. That is the echo. Sometimes the immediate trigger is weak oil prices. Sometimes the trigger is high oil prices with disrupted exports and broken shipping conditions. The point is not whether the path looks identical. The point is that sovereigns under pressure turn reserves into liquidity. That should not shock you. It should educate you. Again, not because gold stopped being valuable, because it was valuable enough to mobilize. This is the error ordinary investors make over and over. They cannot hold two truths in the same frame. Gold can be strategically valuable long term. A sovereign can still sell it in an emergency. Those statements are not opposites. They are complements. If a country needs dollars urgently to support the peg, fund the government, pay for imports, or handle the shock of war, it reaches for the collateral that works. Gold works. That is not bearish philosophy. It is liquidity management. Now we move to mechanism 7. I call it the sovereign cash scramble. This is where the paper panic and the physical story connect back to the world outside the chart. The sovereign cash scramble is what happens when governments in stressed regions need dollars right now, not theories about what assets should outperform eventually. And this is one reason gold can get hit, even when geopolitical conditions look tailored, made for a safe haven move. If oil cannot leave cleanly, revenue falls or gets delayed. If military spending rises, dollars are needed faster. If a currency peg must be defended, reserves get used. If businesses and wealthy individuals start moving capital out, the pressure increases. Now ask yourself what a government sells. It sells what is liquid. It sells what can raise dollars. It sells what buys time. That is the sovereign cash scramble. And if several actors are doing versions of it at once, the market feels that pressure. Some of it may be visible in filings. Some of it may show up first in vault flows, swap activity, regional premiums, or the behavior of the major settlement markets. Again, adults watch evidence. Children wait for a single simple headline. This is not me glamorizing opacity. It is me telling you how the real world works. Large actors do not always announce what they are doing cleanly and promptly. Markets still absorb the consequences. That is enough. Now let us move to mechanism 8. I call it the smart money difference. Please pay attention here because this is where a lot of confusion clears up. Smart money is not defined by intelligence alone. It is defined by structure. The smart money difference is that institutions and serious holders do not all play the same game retail plays. Retail is often late, leveraged, narrative-driven, emotionally attached to the recent move. Institutions are not always right, but many of them operate with process levels, inventory awareness, funding discipline, and a much cleaner separation between a short-term tactical event and a long-term thesis. That is why smart money can be selling paper exposure while another class of smart money is accumulating physical. Those are not contradictions. They are different time horizons and different instruments. A futures desk may dump, an algorithm may dump, a leveraged ETF may be forced to dump at the same time, a central bank, an Asian buyer, or a physical accumulator may quietly take delivery. If you see only one side, you think the whole market has spoken with one voice. It is not. The market is a battlefield of time horizons. That is one of the most important truths in finance. The short-term actor and the long-term actor are often doing opposite things in the same week. That does not make one of them stupid. It means you must decide which game you are in before you let the noise choose for you. Now, let me make the identity flip explicit. Most people who say they own gold as insurance do not act like insurance owners. They act like momentum tourists. That is the problem. A tourist wants a quick reward. A strategic holder wants the asset to do its job over a longer arc. A tourist gets offended when the chart turns against him. A strategic holder asks whether the mechanism currently hurting the price changes the long-term role of the asset. Those are different minds. If you are going to touch precious metals at all, decide which person you are, because a tourist in a gold reset becomes a donor. A strategic holder can at least interpret the move correctly. Now let us move to the long-term case, because this is where people make the next category mistake. If paper gold crashes during a war, some investors conclude that gold as monetary insurance must have been overrated. What may actually be happening is that the path to the long-term case just got dirtier. That is different. The long-term reasons countries and private capital want gold did not vanish because one violent week in the derivative markets went badly. The world is still highly indebted. Reserve neutrality is still under question. Geopolitical fragmentation is still real. Sanctions precedent is still real. The appeal of assets without direct counterparty risk is still real. None of that disappeared because leveraged products imploded and machines sold contracts. In fact, one could argue that a war-driven inflation shock, higher bond yields, and dollar stress make the long-term monetary case more legible, not less. But again, the path is not the destination. That is what weak investors cannot tolerate. They need the path to flatter them, or they abandon the destination. That is a terrible habit. Now let us talk about another mechanism, because this is where many people lose their footing. I call it the time. Horizon split the time. Horizon split is the fact that the same move can be bearish for the trader, painful for the tourist, neutral for the allocator, and attractive for the patient accumulator all at once. That sounds uncomfortable. Good markets are uncomfortable. A1. Weak collapse can be a catastrophe for someone in a leveraged vehicle. The same week can be a simple repricing event for a long-term physical buyer. The same week can be a wait and see moment for someone watching the dollar index and treasury yields. The same week can be a gift for someone who has dry powder and no need to touch the money. That is why you must know your own clock. If you are acting from a daily or weekly clock while pretending you own long-term insurance, you will keep sabotaging yourself. If you are acting from a multi-year clock but expressing it in a fragile leveraged instrument, you will still sabotage yourself. The vehicle has to match the horizon. The horizon has to match the purpose. That is one of the oldest rules in capital allocation. Break it, and you will keep getting punished by moves that were never actually contradictory. They were just contradictory to your confused setup. Now let us get practical. What actually matters going forward. Not your feelings. Not a dramatic thumbnail conditions. Watch the dollar. If the dollar stays too strong, it remains a headwind. Watch the 10-year yield. If yields remain elevated, paper gold stays under pressure. Watch whether the market begins to believe rate cuts are coming back into play or staying pushed further out. Watch the behavior of physical demand. Watch whether the COMEX type stress in paper markets keeps diverging from the underlying accumulation behavior. Watch whether sovereign pressure eases or intensifies. These things matter because gold does not reverse hard on your schedule. It reverses when the pressure that broke it starts losing force. That is a very different thing. This is why I would never tell someone that a violent weekly crash automatically means all clear or automatically means dead asset. Both statements are intellectually lazy. A reset can continue. A reset can also become the gift. You do not know which by screaming louder. You know which by studying the structure. That is the only adult answer. Now, let me give you the operating system I would want you to install if you are going to survive a market like this with any dignity. First, separate paper from physical in your mind immediately. They share a reference price. They do not share the same holder behavior. Second, do not use leverage to express a long-term monetary thesis unless you enjoy turning valid ideas into emergency situations. Third, understand the domino chain, war, oil, inflation pressure, Fed path repricing, higher yields, stronger dollar, machine selling, margin calls. If you cannot explain the chain, you should not be making dramatic decisions based on the end of the chain. Fourth, respect sovereign selling as a source of pressure without making the childish leap that every seller has changed his strategic belief. Fifth, watch who is taking the other side in physical. That matters immensely. Sixth, remember that resets are allowed to last longer than your emotions would prefer. Do not build your behavior around a demand for immediate reassurance. Seventh, know whether you are an insurer, an accumulator, a trader, or a tourist. Those are different identities. They require different tools. If you confuse them, the market will punish you. Eighth, if you care about long-term ownership, think in unleveraged terms. Physical where appropriate, straightforward exposure where not cash flow patience. Ninth, stop asking the chart alone to explain the thesis. The chart shows stress. It does not explain the seller. Now let me say something blunt. A lot of people who lost money in this gold crash are not victims of gold. They are victims of the structure they chose, leveraged daily reset products, no distinction between paper and metal, no understanding of algorithmic flow, no time horizon, no process. Those are not random misfortunes. Those are self-inflicted vulnerabilities. I am not saying that to be cruel. I am saying it because pain without precision does not teach the right lesson. The lesson is not gold betrayed me. The lesson is I expressed a volatile thesis in a fragile vehicle and then acted surprised when fragility showed up. That is the lesson. Learn it once. Do not pay tuition on it twice. Now let me bring this together into one clear choice. Game one is the emotion game in that game. You see the red week, you declare the thesis broken, you obey the paper market's panic, and you become another participant who converts temporary stress into permanent damage. Game two is the structure game. In that game, you diagnose the chain reaction. Distinguish the derivative crash from the physical market, identify the role of sovereign liquidity needs, respect the possibility of a longer reset, and position yourself according to the instrument and time horizon you actually intend to own. I know which game I would rather play. And now let me leave you with the blade. Gold did not disprove itself this week. Paper gold got margin called, machines did what machines do, leveraged products behaved exactly the way fragile products always behave, and real metal kept moving toward the hands that still wanted it. Miss that, and this whole episode looks like a betrayal. See it clearly, and it looks like what it really is. A transfer, a violent, confusing, emotionally expensive transfer from weak structure to strong structure. That is how serious markets cleanse themselves. Not politely, not with perfect explanations, with pain first, understanding later. I would rather you reverse that order, understand it now while the pain is still visible. Because if you cannot tell the difference between gold as a store of value and paper gold as a leveraged battlefield, then the next phase of this market will not just confuse you, it will charge you for the confusion severely, and there is no reason to pay that bill if you are willing to think structurally instead of emotionally. That is the job, now do it. Or the market will do it for you in its own language, which is always more expensive than mine.